All right, everybody, welcome back to Cover Call ETF Investing. If you're new to the channel, I'm Jordan, invested 100% in Cover Call ETFs. And today I have a special returning guest, a community favorite, Si Katara from TappAlpha, to give us a TSPY update. How are you doing, Si?
Jordan, I'm doing great. Good to see you again, and I know you're in the same time zone as I am, just a few hours north. So we're starting to get into our summertime season,
Oh,
which is
I know
fun.
it's perfect. This is the time of year I go up to Kelowna, which is a 4 hour drive just northeast of Vancouver, and it's like for everybody in Vancouver, that's sort of the mini Vancouver of the interior. So we all like getting out there. It's wine country, it's boat country on the lake, so it's great up there. So heading up there pretty soon.
Oh, send some pictures so I can live vicariously, please.
Yeah, to me it is like it's like a second home. I would probably live there if I wasn't building ships here on the mainland. But for the sake of this interview, everybody, we're going to be just again doing a brief update on T-Spot and more specifically the performance and strategy behind this zero DTE fund and show exactly what it's been doing ever since the dreaded Liberation Day. I know that's a hot topic, but and it's unearthed a lot of chatter about volatility in the market. So we want to just pick Si's brain about all that good stuff. So maybe before I share my screen, we go through some tabs. Si, what have you seen in regards to the zero DTE strategy? What's the chatter like in the industry about zero DTE and with the volatility that we've seen since April?
It's one of those things. What's happened since April and since it kind of reinforces a simple truth. I think you can't predict markets, especially when they're event driven, like Liberation Day was, and then the tweet on April 9th that changed everything, especially for zero DTE funds. The only thing you can do is really manage risk. And so one of the things that we did coming through that, it's a blessing in disguise because we just literally went through what is could be considered the worst case scenario for a zero DTE strategy, and we made it through pretty well, and we've gotten stronger because of it. And so I think the main thing is, hey, make sure that you're strengthening the capabilities and the tools that you have in order to manage the risks that we're seeing in these markets. Because this is a historic period that we're going to look back on 10, 20 years from now and say that was wild volatility and some very, very interesting times that we lived through.
Yeah, I want to say I've seen a chart of say the VIX, and for those if you're not familiar with it, the VIX is just another index that measures the overall market volatility, more specifically, I guess, to the S&P 500. But I want to say it reached a high of somewhere in the 50 to 60 range. Like it was the third highest mark in the VIX in what history? That's wild.
Unbelievable. April, you just look at the day. So just to frame it, when I started doing zero DTE covered call investing was right when zero DTE came out. And the average VIX levels that I was experiencing was 12 to 15, maybe 16, 17. April comes, and all of a sudden on April 9th, for example, the VIX was over 50, 50 to 55. And through the month of April, the average, there were 2 weeks where the VIX was over 30, back to back to back, because of all the uncertainty that was going on with trade policy. So this is a very rare, I think, occurrence. But just because it's rare doesn't mean that we shouldn't be prepared for it. They call it tails, and it's tail risk. Tail risks statistically aren't supposed to happen ever, but they do. And that's the thing that you've got to make sure from a risk mitigation standpoint that you're ready for. And so we're certainly in a stronger place, I think, having gone through it.
So, Sai, with the zero, let's just kind of jump back in time to when the VIX spiked the way it did. I mean, what is the major benefactor for zero DTE during that quick spike versus if you're just writing call options for the month, for the week? Like, can you maybe for the audience just differentiate, how a zero DTE strategy can basically harness like that volatility?
It's really interesting. If you look at zero DTE pricing, it's directly proportionate and correlates to volatility. And so VIX is volatility on the S&P 500. When the VIX is really high, the premiums are also very high. And so just naturally, one of the main differences in why, for example, we built TSPY the way we did, we were choosing between, let's say, a traditional 30-day option strategy versus using 0-day. And we just looked at the premium comparison. And for the same level of risk, you can get 4 to 4.5x the premium opportunity versus a 30-day. And so for us, it just made all the sense in the world. If you're going to take that level of risk, why not get compensated more for it? Well, that risk across the board was highly elevated in April. So what we ended up doing, instead of getting greedy and trying to capture more premium, we use that extra premium to buy us more and more safety. So that's why, for example, on April 9th, of all the 0DTE funds out there, I think we fared the best, because guess how high out of the money we set our strike that day?
Huh.
5.25%
Wow.
out of the money.
Yeah.
We've
So,
never set anything that far out by an order of double or triple. Like normally it's much less than that. But that day the VIX was so high that we had lots of headroom, and we thought there's no way the market's going to go up more than 5.25%, until it did, because of the tweet where all of a sudden the tariff news was, oh, we're pausing tariffs for 90 days. And the market shot up 9.5% in 2 to 3 hours. That was historic, right? That's only happened 3 times since World War II. And the last time it happened was 16 years ago. So, that hurts 0DTE funds. But the question is, how do you recover? And what are the things that you're going to do differently to manage those events? Because we're in a little bit of a new paradigm. So we still have to be prepared moving forward. And I think that was the biggest lesson that we had.
yeah, and I take that through this experience, both on the downside with high volatility and then on the upside, the quick recovery. I mean, what kinds of lessons or implementations you've put behind TSPY to, to maybe capture more of that upside when these sort of market induced events happen, where you do maybe expect some sort of rebound or some sort of bounce back in the market.
It's such an important question and a big point. So one of the things we did 3 things. First thing we did, immediately after April 9th, we modified our prospectus to add a couple more tools to the toolbox. So one of the things that we learned was, hey, when the VIX is super high, you can feel it like a coiled spring. Like something could trigger it, and it was the tweet that day that did. So what do we do in the event that VIX is super high? So we ended up adding 2 things to our toolbox. One, we added the ability to do a credit spread. So basically just buying a long put further out of the money than our position, so that if the market gaps up really fast, think of it as catastrophic insurance to the upside. The second thing is we added the ability to buy a protective put on the downside. So it's basically up and down catastrophic insurance that we now have the ability to do because we updated our prospectus. That has provided a lot of peace of mind, and we have rules around when to apply it. We don't do it very often because the trade-off is it cuts into premiums, right? You're paying to buy the insurance. So we really do it only in occasions where the market signals sort of tell us, hey, you should probably think about putting some extra safety in. Second thing we did, our trading, we had pretty efficient trading, especially for an ETF. So it took maybe 20 to 30 seconds to kind of go through the traps to get orders in and filled. When you're doing 0DTE, when markets are moving fast, 20 or 30 seconds is a lifetime. So what we ended up doing actually was integrating right into our underlying fintech, which, one of our other differentiators is like we have really powerful technology underneath that helps us run the fund. So we tied in real-time trading using an institutional order placement system called the Financial Information Exchange, so that now instead of trades taking 15 or 20 seconds, they trade in milliseconds. And what that has done for us is it has improved our limit order fills by about 10 to 15% in better premiums. That directly correlates to better returns ultimately for the positions that we take. So it's really been adding a meaningful boost to the fund. And then the third thing we did is there's a lot of data analytics that we already had, but we ended up building in this advanced sort of marketing analytics underneath. Think of it like a fish finder for the strikes that are available and like where is their volume and where is their movement in the market. We had it informally. Now we formalize it into the fintech so we can see beneath the surface of what's going on with the market dynamics. That is super helpful to give us a more complete view to understand like when movements are happening, why they're happening. And that helps us get ahead of a little bit of from a risk management standpoint. Oh, you can see here's a powder keg that's already under the market, under the surface. Now we can see it and actually manage for it. And those three things have been game changers for our ability to sort of manage the fund through a really, really volatile time.
Perfect. Yeah. I mean, I would imagine, especially when you see markets move the way they do, it's all the institutions that are making these jumps happen. So being able to get in with those quick trades, I would imagine that keeps you competitive with the big players out there. We're going to go through a couple of tabs here at the top, but we'll start on the TappAlpha website. Just for those who are a little bit newer, maybe who are looking around the market for an S&P 500 kind of ETF, and maybe they like the idea of income, maybe get some growth out of it as well. It's a little bit of a mini refresher for those. Your distribution, naturally, if you're an income investor, everyone's got eagle eyes for this number right here. And just to be clear, this is the forward-looking yield.
This is the distribution rate is actually based on backward-looking distributions.
I see.
So, yeah, so any fund actually can't promise future distributions from a compliance perspective, but this is what we've done historically, and we try to the best of our ability to be super consistent with the distributions. But again, there's no way to fully guarantee that because no one's got a crystal ball for what the market will do. But yes, so we're currently distributing about 14 to 14.5%. Annualized distribution rate.
Okay, perfect. And I know you guys have pretty well kind of hovered in this range for your strategy. And then here we got that $37 million in AUM, which I mean, is that's like how would you find other new ETF providers? I mean, are they looking at similar numbers to you, or are you on the back end in the mid range? Are you higher? Like, where do you think TappAlpha sits amongst maybe the newer issuers out there as far as AUM is concerned?
So it's interesting. As a first-time issuer, first-time fund, we came in with just a new idea to try and provide something a little bit different to the marketplace. But we started with $0 on seed funds. We don't have institutional back end that is able to start a fund with 50 or $100 million like a lot of the other ETF issuers that have 10, 15, 20 other funds. And so for us to go from 0 to 37 million in about 10 months, from what I understand, is a relatively unique, I think, growth trajectory that we're really grateful for. And the main thing is like, the only reason we're here is because of folks like the folks that watch your content, the ones that educate themselves, that are interested in new ideas, that look for performance that can actually get into something that maybe others haven't heard of yet. And so, we're small when you're comparing ourselves to like JP Morgan and the big guys and, some of the competitors. But for a first-time issuer, first-time fund, it's not that often where you see 37 million in assets just 10 months after a product launch. So we're so grateful to the communities that have believed in it and have trusted us with the assets to help them meet their goals financially.
I would happen to agree with you, just as someone who covers this content, or at least, sorry, these kinds of funds. You might get an issuer, then they have this sort of shrapnel approach where they just dump just a ton of newer ETFs, see what sticks, but there's not necessarily a rhyme or reason for it. It's just kind of hopefully the investor community latches onto one and then maybe just build it out from there. So the fact that TappAlpha has one fund and it's like you've really poured all your time and energy, your soul into just one thing to make it the best thing it can possibly be. And in particular, I really enjoy it when fund managers make like certain, like maybe what they already have even better. And especially if anyway, they're just focusing on just the one thing, not necessarily abandoning old stuff and trying out some new stuff. Just make what you already got better. So that's what you're doing with TSPY. We got 68 basis points, right in that wheelhouse of just average from in my experience with this. I'm sure yours as well. The
Mhm.
distribution history, you keep it on the main page here. Um, Going all the way back to October, and just to show people just how consistent TSPY actually pays out, you can see that it kind of gives out a distribution within a fairly narrow band, right? You see a lot of 29 cents in a bit, 29, 27, 28. And also, too, on the American side of things with cover call ETFs, unlike in Canada, the American side typically does have more variability in their distributions. Canada seems to have a lot more. It's like this is the one number it's going to be. And if they make more on the premium, or if they make more, they just reinvest it back into the NAV. But it can also go the other way, or the NAV shrinks because they can't completely pay it out, but it seems to average out in the end. And we still get growth out of those funds. So great to see that. I would say you're probably one of the more stable issuers out there. Sometimes we can see quite the erratic distributions. Can you speak to that a little bit of like how do you make it as stable as it is?
It's one of those things, and think about also what we went through in March and April.
Yeah.
So, you see a little bit of variance in the absolute dollar number, but the distribution percentage, the market drew down 18%. And so when your denominator gets smaller and you don't also reduce the numerator, then your percentage actually goes up. We did that deliberately because we understand that a lot of our investors that are looking for that consistent income need that consistency independent sometimes of what the market does. So how do we actually accomplish that? There's four buckets where assets sort of exist in order to sort of fill them. And guess what? This is a hedge strategy. So like when the core equity goes down, volatility is up. Guess what tends to go up? Your option premiums.
Yeah.
So it helps balance it out across those categories so that we're able to actually deliver a relatively consistent distribution. And I think that's one of the most important things is like we know our investors are counting on that income. So we want to be as consistent as we can. Obviously, we can't predict the market, but we have some shock absorbers that we can actually use in order to sort of smooth out that income. So that's really the driver of how we were able to deliver pretty consistent income. And this feels like the right number for the investors that are investing in TSPY is around 14%.
Yeah, it is a great number. I think you're right in that sort of sweet spot where you can still get the growth, you can still get a nice attractive yield. I mean, these days it's funny to me that the amount of yield that people can get these days is obviously there's more stuff out there where you can get higher yields, of course, but it's just the potential long-term downsides of those higher yields at the price you're going to pay for that sort of natural price appreciation. One thing I definitely tell my audience is like I'm always trying to look for that. What is that like top end potential price appreciation and match it with the top potential yield, and what's that equilibrium? And
Mm-hmm.
for my portfolio in particular, that seems to be in the 10 to 12. I think it is based on the other, as the industry matures, that yield is moving slightly higher up. I would even say maybe 13%. Of course, I'm I'm in Canada, so I'm more into the Canadian cover call stuff, so I can at least speak on that end of things. We're definitely, I could probably say on the 13% range, but for what I see here, for all the various S&P 500 cover call ETFs out there on the American side of things, you're well within that range of of that stability and as far as growth as we're about to look at. And yeah, I think the proof is in the pudding with the history here in the distributions.
Sort of hit on something that's really important too. It's the balance, because if you're counting on this for income, you don't want that nest egg to shrink over time. So if distributions are too high, guess what happens? Your nest egg starts to chip away and get smaller. And when that happens over time, so do your distributions. So it's a cycle, like you said. You've got to find a balance where you can sustain the income level from the fund without actually depleting your underlying capital growth too. And so for us, that balance between growth and income is such an important balance to strike. And so far, we've been doing a pretty consistent job of it. But again, all of it's really tied to total returns. What's the underlying total fund delivering, and then what are you able to actually distribute from it? And that balance is a really important one to try and strike.
It is. And just to look at how T-SPY has been performing, just as we were talking about at the top of the interview here, is how has T-SPY performed against all of these other sort of, it doesn't necessarily have to be zero DTE, but sort of an S&P style cover call strategy. You got XDT from Roundhill, you got the S&P 500, you got iSpy from ProShares, SPY from Neos, JEPI from JP Morgan. So like if we go through here, I mean, back when Liberation Day was announced and then the recovery, T-SPY has been on this nice upward trajectory until basically the time of recording here. And T-SPY is on top. And is there something you can maybe, I don't know how much you can really get into it, like speaking about other strategies? I know I'm bringing it up on screen here, but can you maybe speak to how has T-SPY been able to outperform all these other funds and the S&P 500 since Liberation Day on, or I think we backdated it all the way to April 11th.
So the recovery is really important, and thanks for bringing this up. The way I think I'd position it is this: like cover call strategies in general are, the goal is to sort of achieve an outcome where either you're trying to get some yield out, some distribution out, but ultimately like total returns is kind of the magic metric. So for T-SPY, like after April 9th, it was really important to make sure that if there was a recovery, because no one had a crystal ball back then, that we could tune the fund to take good advantage of that uptick. And so the thing I'll say is, there's two strategies that are shown here. One is longer dated, kind of the 30-day strategies like SPY and JEPI. And then there's the short dated, zero DTE. One of the big potential benefits of short dated is you have just more swings and more at bats to capture more upside when the market's going up. So that's one distinction that you see on the chart. And then number two, kind of those three big fine tunings that we did have really helped us with fund execution that has also helped us continue to potentially outpace. So for us, like we're just really ecstatic about looking at our compared performance to the underlying security of the S&P 500. S&P has done 15.1% over the last 2.5 months, which is bananas by any metric. And because of the modifications we've made, we've been able to actually capture all of that and add, another 205 basis points on top over that period of time. And so that's exactly what we want to see from the execution part of the strategy, especially in markets where volatility, if you can harvest it right, provides some opportunities. But the most important thing I think I'd say is just the risk management side of it, and what we were able to do over the past couple months has really been the difference maker for what's happened since Liberation Day and since that big 9.5% spike.
One of my favorite things with talking with you, Si, and I think the audience would agree with this, is, it's quite clear that you are someone who backs a product you very much believe in, your heart and soul is into it, you want to make it better, you go through a period like we've seen over the last few months, a massive spike in volatility, and you're right back at the drawing board. You're like, we have this product, let's try and make it better by incorporating other things into it so that it can be the best that it says it is, which is income and growth together, right? That equilibrium that we just talked about. Like, let's try to get, what is that maximum potential return? What is the maximum kind of yield that we can maybe give out to and keep it stable? So I think it's really cool to see that. And I just wanted to share with the audience too. We're going to just jump inside this is the product I've developed, and it gives you just a complete view of just what are on sites like, say, Google Finance or Seeking Alpha, but also merge it with info from the fund manager websites all into one place. So one thing I wanted to show everybody here was what is the AUM history of TappAlpha and with TSPY more specifically. So we can see that, hey, look, when I added it to this tracker, it was around 5.6 million. It gets a massive jump into December to 7.8. We see, like, guys, these are massive growth numbers here as far as percentages are concerned. 7.8 all the way up to 12 million. From January to February, we get another 30% increase in AUM. So it, to me, for all of the time I spend in this tracker and looking at AUM, it's like these are great, healthy numbers to see for the audience if they are, and they should consider this to be important. 15.6 million to 18.1 million, and then of course another massive jump, 18 to 31. And I guess if Liberation Day didn't happen, we might be talking about a TappAlpha or a TSPY already at 50 million. But it, of course, April comes along, the entire market just drops, everything's thrown into chaos. T-SPY's down basically almost 25%. But check out this rebound. Basically from May to June, it recaptures everything that it lost. And then we're kind of back on the same sort of trajectory. Now, as of like right now, we're at 37.1 million with T-SPY. So these are great growth numbers. Psi, very impressive to see on just a percentage growth basis overall. So this is the kind of trajectory that if you're thinking of investing in T-SPY, like, look at where it's going and think about how much better it can possibly get.
One thing I'll add too, so that negative change of 24% in April, it was interesting. I found out like what the driver was behind that. One thing I wanted to speak to is, that negative 24%. So in March, there was actually a market maker that invested $10 million of their own book into T-SPY. And the challenge with market makers are they don't have the same drivers for why they're investing in a particular fund. So our goal is to be a long-term investment vehicle and balance growth and income. Market makers in many cases are much more short-term thinking, and they're looking to get extra dollars squeezed out of the funds that they invest in. So when April came and basically the risk calculations of the whole market changed, they rebalanced their whole book. And when that happens, they actually pulled that $10 million back out of T-SPY. So those dollars weren't even real investment dollars from RIAs or individuals looking to invest in T-SPY for the same reason we all do. So if you take out that lump, the actual growth curve is pretty consistent. And I think the best part about this is that the replacement that's happened. So now we're at an all-time high of AUM, but the AUM that's in there is real investors looking for long-term investment solutions versus market makers that are looking for short-term incentives. So that, to me, I would way rather have long-term sticky investors, investing in AUM and having it grow more smoothly than these big lump hits and withdrawals. So the main thing I'll say to this is it's just, I don't know how else to say it, but like a huge heartfelt thank you to the retail community, because it's the retail investors that are smart, they're educated, they're learning about this, they're watching this stuff every day, and they're seeing how it can actually make a difference in their lives. Those are the folks, and to trust us to do right by you, and every dollar that comes in means a lot to us. And so just want to say a heartfelt thank you that this AUM is a testament to your belief in what we can hopefully deliver, and we just really appreciate it and want to continue being transparent and open and share all the things that we're doing, because it impacts you just like it impacts us. We're huge investors in the fund as well, and it's not lost to us that there's lots of choices out there. So really appreciate the support, and also to you, Jordan, for having conversations like this to talk about what we're doing at TappAlpha.
Yeah, well, it's an awesome fun to talk about, especially for those who, I mean, up here in Canada, I mean, a lot of the time, if you're going to be investing in anything really American related, a lot of people are going to do that within our version of a retirement account, which is an RSP up here. there's a tax treaty with the U.S. where it kind of shields us from any sort of withholding taxes, really, as long as we're invested directly into, say, an ETF issuer like TappAlpha or any other one, or any direct, equity exposure. So even for the Canadian audience, like, you have a means, or at least you have a means and an incentive to invest in American ETFs like TSPY, and especially through the RSP. So they get exposure that way. Of course, for the Americans out there, this is just, of course, one of many choices out there. But hey, who's in front of their products? Is it Psy with TSPY, or is it, some of these other guys with their own products? It's I think it helps to put a face in front of these ticker symbols, so that we just get to know what this thing is actually all about, and also, just get to know a little more about how the fund operates, what the issuer is like. It's all good. So it's always a pleasure to talk with you, Sai, in that regard.
Excellent. I appreciate it, Jordan. And actually, one other thing I'll add to it, a lot of your viewers and other viewers too have actually written to us directly, talking about sort of future products and things. They're like, oh, can you guys do this, but on the NASDAQ 100? And so I'm getting a lot of these sort of votes of confidence, I'll put it that way. And the thing I'll add is, the way that we've built all the capabilities that run TSPY, all of that intelligence and fintech underneath has already been effectively ported, so it can do the exact same effective strategy on other tickers. And the first one we're going to do next is TDAC, which will come as soon as TSPY hits 50 million. So to your viewers, thank you so much for the messages. Keep them coming. That's what's driving us to then launch these next products. And all of this will tie together, where the underlying technology will continue to get smarter and smarter and smarter, and it'll benefit every ticker that's on the TappAlpha platform.
Perfect. Well, thank you for sharing your wisdom, your knowledge, especially when it comes to TSPY. I know the audience really appreciates it.
Thanks for having me, Jordan. Great to see you.